Hey traders, welcome back to the Modest Money channel. In today's video, I'm covering the best fractional real estate investment platforms. I'm going to compare three of the best options out there, breaking down their strengths, weaknesses, and everything in between. So, whether you're an accredited investor or not, this video is for you. Let's start with a quick background on these platforms. EquityMultiple is a platform designed specifically for accredited investors, offering institutional quality commercial real estate deals. It's been around since 2015 and focuses on providing a variety of investment structures, including equity, preferred equity, and debt investments. Now, Fundrise was founded in 2010 with the goal of democratizing real estate investing, allowing both accredited and non-accredited investors to participate in a diversified portfolio with a minimum investment as low as $10. And then we have First National Realty Partners, or FNRP, which, like EquityMultiple, caters exclusively to accredited investors. However, FNRP specializes in grocery-anchored commercial properties, focusing on necessity-based businesses like Walmart and Aldi. As I just mentioned, EquityMultiple and FNRP both require you to be an accredited investor, meaning you need a net worth of over $1 million, excluding your primary residence, or an annual income of at least $200,000 for the past 2 years. But don't worry, Fundrise is open to all investors, making it the most accessible option. Now, let's talk about what you're actually investing in. EquityMultiple is all about giving investors access to high-quality, institutional-level commercial real estate. But what I really like is how they structure their investment options. Instead of a one-size-fits-all approach, they break it down into 3 categories: keep, earn, and grow, each designed for different goals. Whether you're looking for short-term cash flow, steady income, or big upside potential. If you're someone who likes short-term, lower-risk investments with solid returns, then the Alpine notes could be a great fit. These are short-term notes with fixed APYs ranging from 6.1% to 7.5%, depending on the length of the term. You can choose from 3, 6, or 9 months, and the best part? No fees. That's pretty rare when it comes to real estate investing. You can also roll over your returns into another note to compound your earnings. Or if you see another EquityMultiple deal you like, you can move your money into it after just 30 days. So if you're looking for a flexible way to earn a steady yield without locking up your capital for years, this could be a solid option. Now, if you're more into consistent passive income with a strong level of security, then the Ascent Income Fund might be worth a look. This fund focuses on senior commercial real estate debt, which means your investment is backed by actual real estate, and you're first in line to get paid. It has a historical yield of 9.0%, and you can start with as little as $5,000. And here's something I really like. You're not completely locked in forever. You can request a redemption after 1 year, with additional liquidity options every 6 months. So, if you want that predictable quarterly income while still keeping some flexibility, this is one of the better private real estate income funds out there. But if you're thinking long-term and want to go for big gains, EquityMultiple also offers growth-focused investments in commercial real estate. These are value-add and opportunistic equity deals, meaning they focus on properties that can be improved, repositioned, or bought at a discount for a higher resale value later. They target net IRRs of 18% or more, which is a pretty strong return compared to traditional real estate investments. One example is their Brooklyn Industrial NPL acquisition, a 5-year investment in the industrial real estate space, one of the hottest sectors right now. These types of deals come with more risk, but if you're willing to ride out the hold period, they can offer some serious upside. Fundrise has started expanding into alternative investments, like private credit and private companies, but for today, I'm focusing on what they're best known for: real estate investing through their flagship real estate fund. This fund is designed to give you long-term appreciation and steady income by spreading your investment across a mix of properties. So instead of picking individual deals, you're getting exposure to an entire real estate portfolio. So, what exactly are you investing in? Fundrise is big on real estate in the Sun Belt, places like Texas, Florida, and Arizona, because these areas are seeing huge population and job growth. A major focus is build for rent, BFR communities, which are single-family homes designed specifically for long-term renters. This is a trend that's exploding right now, and honestly, it makes total sense. A lot of millennials want the benefits of a home without the commitment of buying, and that demand isn't slowing down anytime soon. Another big part of their strategy is workforce housing, which targets middle-income renters who need affordable places to live near job centers. Housing prices keep climbing, wages aren't keeping up, and demand for this type of housing is only growing. It's the kind of investment that holds up in almost any market, which I really like from a risk perspective. One thing I appreciate about Fundrise is their value investing approach. They focus on buying properties below replacement cost, meaning they're getting real estate for less than what it would cost to build today. That's a smart way to minimize risk and maximize potential appreciation. They also keep some flexibility in their strategy, so they can jump on undervalued deals when market conditions shift. All right, let's get into the risk and returns of these platforms. All investments come with a certain level of risk, and usually the higher the reward, the higher the risk. In general, investments only open to accredited investors are riskier. Although First National Realty Partners is only for accredited investors, the fact that they invest in recession-proof grocery-anchored real estate makes it less risky in my opinion. When the inevitable recession happens, as they do from time to time, people still have to eat and buy household staples. Fundrise's fund currently has 224 projects across 30 markets. Real estate is quite localized, so this diversity lowers risk. Next up, fees. Nobody likes paying fees, but they're part of the game, and they can eat into your profits if you're not careful. EquityMultiple charges either an annual asset management fee of 1% or a flat $250 annual service fee for equity investments. Plus, they take a percentage of the profits, typically around 10%. Debt and preferred equity investments come with a 1% servicing fee. Alpine notes, however, don't have fees, which makes them a solid option for investors looking for short-term, low-cost returns. There may also be small administrative fees ranging from $30 to $70 per year. Fundrise is known for having relatively low fees compared to traditional real estate investments. They charge about 1% annually, 0.85% for management, and a 0.15% advisory fee. This makes it a cost-effective choice, especially for smaller investors who want to avoid the higher fees of private equity real estate deals. FNRP's fees vary depending on the deal. They include asset management, acquisition, and disposition fees, but the exact amounts depend on the specifics of each investment. Since FNRP doesn't have a standardized fee structure like Fundrise, it's important for investors to review each deal carefully before committing. So when it comes to fees, Fundrise charges the lowest fees out of the fractional real estate platforms I'm covering today. Liquidity is another big factor to consider because real estate isn't the kind of investment you can cash out of overnight. EquityMultiple's investments are generally illiquid, meaning you'll need to hold them for the full term, often 5 to 7 years. However, their Alpine notes offer more flexibility, with terms as short as 3 months. The Ascent Income Fund also has some liquidity options, allowing redemptions after 1 year, with additional redemption opportunities every 6 months. Fundrise investments are also considered low liquidity. While some of their flagship and income funds allow withdrawals without penalties, most EREITs come with restrictions, and early withdrawals can result in penalties. FNRP investments, like EquityMultiple, have long hold periods and are generally not as liquid as publicly traded REITs. If you're investing with FNRP, you should be prepared to hold your position for an extended period of time. So, real estate in general isn't as liquid as other investments. Out of the 3 platforms I'm reviewing today, Fundrise offers the most liquidity. You do have to submit a liquidation request and wait until the end of the quarter. But since it is a large fund and open to all investors, you shouldn't have problems liquidating your shares. Here is my breakdown of the platforms and their features. For me, Fundrise is the winner. First of all, it is open to all investors. On top of that, they have a diversified fund that charges less fees and is more liquid. But really, it depends on what you're looking for. If you're an accredited investor and want access to high-quality commercial real estate, EquityMultiple and First National Realty Partners have their strong points. At the end of the day, all 3 platforms provide different ways to invest in real estate, so the best choice comes down to your goals, risk tolerance, and investor status. If you want to check out these platforms further, use the links in the description. If these platforms offer any discounts or promotions, I'll make sure to update them there. If you found this breakdown helpful, don't forget to hit that like button and subscribe for more deep dives into the best investment platforms out there. Thanks for watching and happy investing.